Mike, you dusted off the old recession playbook, and many people didn't want to look at it. You pushed it and pushed it hard and put on risks when others were uncomfortable, and it was the right trade to make through to the end of 2020. Into 21, Mike, everyone's still looking for that historical parallel. Do you think that's helpful right now, and where do you find it? What do you lean into?
Yeah, well, thanks, guys. Thanks for having me on. Look, I think the recession playbook, recovery playbook is right on track. Every recession crisis is different, unique in its own way, but markets, obviously look forward. And, I think the markets are very clear right now in their view about 2021. It is going to be a boom in terms of economic growth. Yeah, we have to get through these hurdles of vaccination and all the hand-wringing around politics and everything else, but ultimately the market is discounting a very powerful recovery. In fact, the move that we've seen more recently in things like small caps and the cyclical parts of the market that we've been preferring, just, kind of confirms that even more for us. Here's where we think things are going next, though. The next step in the recession playbook is a consolidation for a long period of time. You always get multiple expansion as earnings are normalizing out of the recession. That's what we've gotten. Then you go through a period, you get multiple contraction as people have understood that earnings are going up. And what that means is that earnings will continue to go up in terms of revision, but multiples will come down, and the market just goes sideways for a period of 6 or 7 months. When I say the market, I mean the S&P 500. That doesn't mean there's nothing to do, right? There's going to be terrific rotation still and things to do within the equity market. That's where all the action is. It's underneath the surface.
Mike Wilson, good morning. The Herfindahl-Hirschman Index is something we study in finance. And, folks, it applies across all of the social sciences. And what this comes down to, Mike Wilson, is a measurement of the concentration in the market. I'm not going to go into the Newtonian math, but, Mike Wilson, you observe we are less concentrated.
Absolutely, Tom, and that's part of the story as well. First of all, as you go into a recession, which, we were talking about in 18 and 19, the market gets more concentrated. The returns become more narrow as the market gravitates to these larger cap companies that are somewhat defensive, and that was FANG in the last cycle. Then as you come out of the recession, what happens is that money that's been concentrated decides, hey, there's other opportunities out there, and it broadens out. And that's exactly what's happened this time around. It's a very healthy development. That's what you want to see. It's actually a confirmation once again that, in fact, it's not just a new bull market, it's a new economic cycle.